You think banks make money by holding your savings safe for you? That's what they want you to believe. But the truth is far darker and far more profitable than any Hollywood heist movie. Every morning when you walk past that marble lobby and those polished glass doors, you're stepping into a machine designed not to protect your wealth, but to manufacture their own. And the raw material they use is your trust. Let's start with the most dangerous lie you've been told your entire life. The lie that your money just sits in a giant vault somewhere, waiting for you to withdraw it. The reality is that the moment you deposit your paycheck, that money vanishes from the physical world and becomes something else entirely. A number on a screen, a liability on a balance sheet, and most importantly, fuel for a fire you never see burning. Banks practice something called fractional reserve banking. It sounds like a complicated term from an economics textbook, but it's actually a very simple and terrifying idea. The bank is only required to keep a tiny fraction of your money on hand. In the United States, that fraction can be as low as 0%. Yes, you heard that correctly. Zero. So what happens to the rest of your money? The other 90 or even 100% of it? The bank loans it out to someone else. And then that someone else deposits it into another bank. And that bank loans it out again, and again, and again. Each time, the original dollar you worked so hard for becomes the foundation for 10, 20, or even 30 new dollars that never actually existed before. This is called the money multiplier effect, and it is the single greatest legal wealth transfer in human history. The bank creates money out of nothing, lends it out at interest, and collects the difference between what they pay you on your savings account and what they charge the borrower. That difference is called the spread, and it's the lifeblood of the entire banking industry. But here's where it gets truly unsettling. The bank doesn't actually need your money to lend. In reality, when a bank issues a loan, they simply create new money in the borrower's account. They don't pull cash from a vault or wait for another customer to deposit first. They type numbers into a computer and call it a loan. That's it. That's the secret. The only limit to this process is a regulatory requirement called the capital requirement, which forces the bank to hold a small percentage of their own money against the loans they make. But even that requirement has been weakened over the past 3 decades through aggressive lobbying and deregulation. The banks wrote the rules, and then they paid politicians to approve them. Now let's talk about the fees. Overdraft fees, ATM fees, monthly maintenance fees, wire transfer fees, late payment fees, foreign transaction fees. These aren't just annoyances. They are a calculated psychological weapon designed to keep you anxious and distracted while they drain your account drop by drop. The average American family pays over $300 per year in bank fees. Multiply that by 100 million households, and you're looking at $30 billion in pure profit for doing absolutely nothing except moving numbers around a screen. But fees are just the appetizer. The real feast is interest. When you borrow money for a car, a house, or a credit card purchase, you agree to pay back far more than you borrowed. That extra money is interest, and it compounds against you like a slow-acting poison. Meanwhile, the bank pays you less than 1% on your savings account, often as low as 0.01%. That means while inflation quietly eats away at your purchasing power at 2 or 3% per year, the bank is using your own money to lend back to you at 15, 20, or even 25% interest through credit cards. Think about that for a moment. You are paying the bank to use your own money, and they are laughing all the way to, well, to themselves. There is a hidden world inside every major bank called the trading desk. This is where the real monsters play. These traders use your deposits as collateral to borrow massive amounts of money from other banks and institutional investors. Then they place enormous bets on interest rates, currency fluctuations, stock market movements, and commodity prices. When they win, the bank keeps almost all the profit. When they lose, the bank covers the loss with the pool of deposits you and millions of others have trusted them with. The 2008 financial crisis happened because these bets went catastrophically wrong. Banks had packaged thousands of toxic mortgages into complex financial products called mortgage-backed securities and sold them to pension funds, insurance companies, and foreign governments. When homeowners started defaulting on their loans, the entire house of cards collapsed. And who paid the price? Not the bankers. They got bonuses. You paid the price through $1 trillion taxpayer bailout and a decade of stagnant wages. But the banks learned a valuable lesson from 2008. They learned that they are too big to fail. They learned that no matter how reckless their behavior, the government will always step in to save them because letting them collapse would destroy the entire economy. That safety net gave them the confidence to become even more aggressive, even more creative, and even more detached from the reality of the people whose money they play with. Credit cards are perhaps the most elegant trap ever devised. The bank gives you a piece of plastic and a small line of credit, and they make you feel powerful. They make you feel like you've arrived. Then they wait. They wait for you to have an emergency, or a moment of weakness, or a genuine need that exceeds your paycheck. And the moment you carry a balance, the interest clock starts ticking. Minimum payments are designed to keep you in debt for decades. If you owe $5,000 on a credit card with an 18% interest rate, and you only make the minimum payment each month, it will take you over 20 years to pay off that debt, and you will pay nearly $10,000 in interest alone. The bank knows this. They calculated it. They designed it. And they profit from every single sleepless night you spend worrying about that bill. Then there is the mortgage industry, the largest and most profitable banking product in existence. When you buy a house, the bank doesn't just lend you money. They own you for 30 years. Every monthly payment you make is structured so that in the early years, almost all of it goes to interest rather than principal. That means if you sell your house after 5 years, you've barely touched what you actually owe. The bank collected tens of thousands of dollars in interest while taking almost no risk because the house itself serves as collateral. And if you can't pay, they take the house, they sell it to someone else, and they start the process all over again. The same house can generate profit for the bank multiple times over decades, each time with a new family sacrificing a third of their income just for the privilege of not being homeless. But here's the part they never tell you in those warm commercials with the smiling families and the soft piano music. Banks don't want you to be wealthy. A wealthy person is a bad customer. A wealthy person doesn't need loans, doesn't pay interest, doesn't incur fees, and doesn't carry a balance. The ideal banking customer is someone who earns just enough to make minimum payments, but never enough to escape the cycle. Someone who stays anxious, stays busy, and stays loyal out of fear. The most successful banks in America have entire departments dedicated to behavioral psychology. They study exactly which fonts, which colors, which phrases, and which due dates produce the highest rates of late payments and overdrafts. They test whether sending a bill on a Monday or a Friday makes you more likely to forget. They know that if they move your due date by just 3 days, millions of additional accounts will trigger a late fee. And they do it. Not accidentally, intentionally. There is a way out, but the banks have made sure you never hear about it. Credit unions, community banks, and decentralized finance platforms operate on a different model. They don't have shareholders demanding ever-increasing quarterly profits. They don't need to invent new fees or predatory products to impress Wall Street analysts. They exist to serve their members, not to extract from them. But these alternatives stay small because the big banks use their enormous marketing budgets to drown them out. The truth is that the banking system as it exists today is not a conspiracy. It's a design. It was built piece by piece over centuries, each new law and regulation shaped by the richest and most powerful institutions in the world to serve their interests at the expense of everyone else. And the most shocking part is that almost none of it is illegal. It's perfectly lawful to create money out of thin air, lend it back to you at interest, and keep you in debt for your entire life. So what do you do with this information? You stop playing their game? You keep only what you need for monthly expenses in their accounts. You move the rest to places they cannot touch. You pay off credit card balances in full every single month, no matter what. You question every fee, every rate, and every promise they make. You remember that the marble lobby and the friendly teller are not there for you. They are there to disarm you. The banks have been winning for 500 years because most people never look behind the curtain. But you just did. And now you can never unsee it. The question is not whether the system is rigged. The question is what you will do tomorrow morning when you walk past those glass doors and decide whether to keep playing their game or finally walk away. This is John Market Pro. And now you know how banks actually make money. The rest is up to you.